The current trading landscape for Plug Power Inc. presents a figure that demands immediate attention. The stock is hovering right at the 1.98 USD mark, having pushed upward by 0.030, or approximately 1.54% during the most recent session. While the markets are currently paused for the Thanksgiving holiday, this closing figure of 1.98 USD serves as the critical baseline for our analysis, a price point that sits precariously between survival and capitulation. When you see a ticker like Plug sitting just pennies away from the $2 psychological barrier, the expectation is often one of two extremes. Either investors are anticipating a massive breakout fueled by a renewable energy renaissance, or they are bracing for a slow bleed into obsolescence. The general market narrative, the story you might hear from a casual observer or read in a superficial headline, is that Plug Power is simply a victim of high interest rates and a slower than anticipated transition to green hydrogen. They believe the stock is down because the hydrogen economy hasn't arrived yet. But the reality is far more complex, and frankly, much more urgent. The deeper reality here isn't just about hydrogen adoption speeds. It is about a company undergoing a radical financial restructuring in real time, maneuvering through a minefield of massive share dilution and a sudden, unexpected pivot away from government reliance. The disparity between the passive hope of retail holders and the aggressive maneuvering of the company's boardroom is where the real story lies. To understand the gravity of this 1.98 USD price level, we have to look beyond the simple green or red percentages on your screen and analyze the structural shifting of the ground beneath the company. Just days ago, news broke that Plug Power is suspending activities related to its highly anticipated $1.66 billion loan facility from the Department of Energy. For months, this loan was the golden carrot dangling in front of investors, the validation that the U.S. government would backstop Plug's expansion. The expectation was that this capital would flow in and stabilize the balance sheet. The reality, delivered with a jarring abruptness, is that Plug is stepping back from this lifeline, citing the potential risks of the incoming political administration and the stringent conditions attached to the funds. This is a contrarian move that forces us to rethink the entire investment thesis. Instead of leaning on Uncle Sam, Plug is turning to the private markets and, more controversially, to its own shareholders for liquidity. This pivots the conversation from government-backed growth to survival by any means necessary, a theme that changes how one might view this asset compared to a blue-chip staple or even a volatile favorite like Tesla stock in its early precarious days. The immediate market reaction to these developments has been a mixture of confusion and volatility, which is precisely what active traders on platforms like Robinhood and interactive brokers tend to flock toward. We have seen volumes spike as traders try to digest the implications of the company's proposal to double its authorized share count from 1.5 billion to 3 billion. This is not a typo. The proposal to potentially flood the market with virtually double the amount of equity is a classic dilution event that often sends shivers down the spines of long-term holders. When you trade on a Robinhood app or manage your positions through SoFi Invest, you often see the price action first, but the mechanism driving that price is supply and demand. If the supply of shares doubles, the value of each individual slice of the pie is mathematically pressured downward unless the company's value doubles concurrently. This massive authorization request suggests that Plug Power is preparing for a long winter of capital raising, selling stock to keep the lights on and the electrolyzers running. It's a high-stakes gamble that separates the casual green energy believer from the hardened market analyst. While the share price fights to hold the 2.00 USD line, we must look at who is actually holding the bag here. You have a fascinating dichotomy between retail optimists, Those using Schwab Intelligent Portfolios or Fidelity accounts who bought in at $20, $30, or even $60, and the institutional sharks who were playing the volatility. Institutional ownership in Plug has always been a battleground. Unlike Apple stock or Nvidia stock, where institutions hold for steady compounding growth and dividends, the funds holding PLUG are often hedging, lending shares to short sellers, or betting on short-term squeezes. The short interest in Plug Power remains elevated, hovering around 28% of the float. This creates a coiled spring effect. Every time the stock dips below 1.90 USD, short sellers may look to cover, providing a temporary floor. But every rally towards 2.20 USD is met with a wall of selling from trapped holders looking to exit. It's a brutal, chalky range that requires precise timing if you are trading via Interactive Brokers trading platforms or similar active interfaces. Let's shift gears to the operational reality of the company, which is often lost in the noise of stock price fluctuations. Plug Power is not just a stock ticker. It is an industrial manufacturer attempting to build an end-to-end ecosystem for green hydrogen. They build the electrolyzers that split water into hydrogen and oxygen. They build the fuel cells that convert that hydrogen back into electricity, and they are attempting to build the liquefaction plants to transport it. The business model is incredibly capital-intensive. It costs an immense amount of liquidity to build a plant in Georgia or Tennessee before you ever see a dime of revenue from the hydrogen sold. The expectation was that by 2024 or 2025, these plants would be printing profits. The reality is that the ramp-up has been plagued by technical delays and cost overruns. In their recent Q3 earnings, revenue came in at $173.7 million, missing expectations, while the net loss was over $200 million. For every dollar they brought in, they spent significantly more. This burn rate is why the dilution we discussed earlier is not just a possibility, it is a mathematical certainty required for solvency. But there is a new angle emerging that could disrupt the bearish narrative, and it involves the hottest sector in the market today: artificial intelligence. Management has recently begun signaling a pivot towards using their fuel cells to power AI data centers. We all know that AI chips like those from Nvidia are power-hungry beasts. The grid is struggling to keep up. Plug Power is pitching its hydrogen fuel cells as the perfect backup or primary power source for these off-grid data fortresses. This narrative shift is brilliant marketing. It attempts to reclassify Plug Power from a struggling industrial gas company to an AI infrastructure play. If they can convince the market and large customers that hydrogen is the solution to the AI power crunch, the stock could decouple from the depressed energy sector and trade with the fervor of a tech stock. But investors using Fidelity research tools or SoFi robo-advisor algorithms should remain cautious. A narrative shift does not immediately fix a balance sheet hole. It takes years to qualify and deploy power solutions for mission-critical data centers. The tension here is between the hype of AI and the cold, hard cash required to build the infrastructure to support it. This brings us to the macroeconomic environment. We're living in a time where the free capital of the past decade is gone. Higher interest rates and risky growth stocks are punished severely for lack of profits. When you look at individual brokerage accounts across the country, from a Fidelity brokerage account in Ohio to a Robinhood crypto trader in California, the appetite for risk is changing. Investors are demanding profitability now, not in 10 years. Plug Power is swimming upstream against this current. They recently closed a convertible note offering, raising nearly $400 million. This was a crucial lifeline, allowing them to pay off older, high-interest debt. But convertible notes are a double-edged sword. They carry interest payments, in this case 6.75%, and they come with the potential for future dilution if the stock price rises. It's a complex financial instrument that keeps the company alive, but puts a cap on the upside for common shareholders until the debt is resolved. Speaking of shareholders, I want to pause here and ask you a direct question. Comment below how many shares of Plug Power you currently hold and what your average buy-in price is. Are you averaging down at these 1.98 levels, or are you waiting for a confirmed breakout above 2.50? Also, do you think the pivot to AI data centers is a genuine business strategy or just a buzzword attempt to boost the stock price? Let me know in the comments. The psychology of the shareholder base is often just as important as the financials. Now, let's look at the technicals on the chart. If you pull up the daily chart on your Fidelity